All right, good afternoon, everybody. Welcome to my weekly update on the mortgage market and where things are at. We've got a lot of good information to cover today. It is still being worked out on the details, so I'm going to share with you everything I know. I promise you're going to have questions that I'm going to tell you I don't know the answer to because, well, I don't know the answer to it. But you will get bleeding edge information from me in my attempt to give you as much great information as I can. As you guys are navigating this market along with me. So let's go ahead and dive in. If you're watching via Facebook Live, welcome. Feel free to post comments on there. If you're watching via Zoom, go into Facebook Live anyway and like it and share it with all your friends. And post your comments on Zoom if you're watching on Zoom so that I can reply if you have questions in the comments field. So let's go ahead and get started with today's update. So first of all, a lot to cover today. I'm going to talk about rates for like 19 seconds. Then I'm going to talk about the Fannie Mae update for like 29 and a half minutes. And then I'll leave 19 more seconds to answer your questions because I really don't have any answers to any questions. So feel free to ask because you'll have 19 seconds for me to answer all of them for you. Guys, this is more confusing than it is helpful. And I want to prepare you for that fact that it is just, there are so many what ifs that I'm still trying to figure out. This information, Fannie Mae snuck it out back in August, and it really was kind of quietly buried into a memo. And we caught it a couple weeks ago and started really digging into it. And it's kind of a thing. It's become a thing. It's grown into a thing. It's one of those things that you don't pay attention to, and you tell your spouse, "Oh, don't worry, it'll resolve itself on its own," and then it grows into some ugly thing that you can't walk anymore because the thing became a thing that turned into a thing, and it's kind of becoming one of those things. So let's define what that thing is in just a moment. Let's first cover rate update. You've been seeing me talk about this for months. We're seeing the same patterns happening over and over again. Let's get my handy dandy little dot thing so that you can see where my finger is. Boom, now I got my handy dandy dot. All right, so up is good. Up means that it is good news for the rate market, but what you're seeing is what we call the secondary market. You're seeing the back end of interest rates, and you're seeing what the rate is that lenders have to pay to Wall Street, to Fannie Mae, and the higher this number is, the cheaper the money is for us. It has not translated dollar for dollar into cheaper rates for the consumer. There's been a lot of reasons why rates have not translated to as low to the consumer as they should, but you see a lot of volatility. That volatility is on the back end of the market. On the mortgage consumer side, very little volatility. We're seeing a little bit, but we're seeing it improve back again. I told you guys last week as we were kind of coming down this chain and we're like, oh man, that's not looking good. It's falling and it's falling some more. And I said, yeah, but it's going to turn around and start coming back again. And it's doing exactly that. So we're seeing ups, downs. Again, down is bad, up is good, down is bad. We continue to see this movement. The truth is the weakening that we saw similar to early August is starting to rebound. So that's exactly what I expect to have happen. I expect rates to stay what we call range bound within a range. And we're sticking in the high twos for most 30-year fixed programs. Depending upon whether you're jumbo, obviously all bets are off. Jumbo rates are definitely higher. But for the most part, you should be tickling the high twos, even with not so great of circumstances. You can get FHA even if you have bad credit in the high twos. So there's a lot of really, really good interest rates that are out there, and we're seeing a lot of stability, and we're seeing a lot of continued, how can I say stability and volatility at the same time? Because we're seeing volatility on the back end of what mortgage companies are paying to Fannie Mae, but because we're not passing all those savings on to the consumer, when rates do pop up a little bit on the back end, we don't really feel it on the front end. That's the simplest way to put it. All right, that was my 29 seconds about interest rates. Now let's dive into the Fannie Mae thing. I literally have one slide about this because I tried to pull together what Fannie Mae said into a slide, into multiple slides, and it became too complicated. And so I decided I'm literally going to show you guys the Fannie Mae letter, and we're going to talk through the letter. But I'm going to give you a high level right now. This issue applies to debts that are not a mortgage, but they may require us to count them in the combined loan to value. Now, there's a lot of confusion right now on how does this impact purchases, and it's the biggest piece I don't have answers to. I have a lot of answers on how it impacts refinances. I don't have a lot of answers to how it impacts purchases, but there are going to be some implications, and that's why I want to give you guys this notice, because I at least have learned enough over the last couple of weeks to speak intelligently about it, as long as I don't answer any questions. Okay, so what we're talking about here, I'll give you a simple example. You've got somebody that did a solar loan, and they owe, $15,000 on that solar loan. Then that person, again, I'm talking refinance because that part, the math is super easy right now. That person owes $300,000 on a $400,000 home. So therefore, they are borrowing 75% of the home value. But Fannie Mae says, no, no, no. This debt that you have, if it is recorded using a UCC, and I'll show you a copy of a UCC filing, but a UCC filing is not a deed of trust. It is a lien on title, but it's a lien that really is saying, hey, we attached a fixture. We attached solar to the roof, and the client doesn't own it yet. And they haven't paid it off. They have a debt against it. So we want to record this lien on the property. We're not going to foreclose. They cannot foreclose on the property with a UCC filing. But they're recording it against the property as a fixture, saying, hey, this is attached to the property. The general thinking I've always had about UCC filings is a UCC filing is the solar company's way to be notified if the property is being sold, because that's a lien on title. And if you go to sell the property, the solar company needs to know that you no longer own the house that their solar panels are attached to. Therefore, you have always all along had to deal with, well, we need to get the solar transferred to the new owner's name. We need to get the solar paid off. You guys are used to having to deal with that. How escrow knows is because of the UCC filing. So the UCC filing is recorded on title, and it says this is recorded by the solar company that this debt is owed to us, and therefore that debt needs to be either paid off or transferred to the new owner. You guys are used to that being dealt with. But what's happening now is Fannie Mae says that $15,000 that is owed on that solar is really a second mortgage in their eyes. And when you have a second mortgage, you have a higher interest rate on your first mortgage because the second mortgage exists. In Fannie Mae's eyes, and Freddie Mac's the same way in this regard, if you owe money on a second, that makes you a bigger risk than somebody who doesn't owe money on a second. And therefore, we're going to charge you a higher interest rate on your first mortgage because you have a second mortgage. UCC filings have never been considered a second mortgage until now. And I'm going to dive into more detail on how all of this works, but that's definitely on a refi, and we'll talk about what I think is going to happen on a purchase. So Fannie Mae will increase the rate and fee, and it could cause the loan to exceed the limit of combined loan to value. We can only loan you a certain percentage of the value of the home. Now, in some cases, I can go up to 103% of the value of the home. But there's times when the debt owed on the solar, or I'll throw in another curveball at you, a pool loan. Now, I don't know how you guys ever transferred pool loans if somebody owes money on a pool. Have you ever had a situation where the buyer takes over that debt, or does the seller always pay it off? I don't know. But if the seller doesn't pay off the debt and it transfers to the buyer, or if you're dealing with maybe a past client of yours that's trying to refinance, this is where it's really stinging us because there is no buyer seller to pay it off. We have to count the total amount. I have a client right now, I'm going to show you the UCC filing, that owes $60,000 on a pool. That $60,000 pool now counts as a second mortgage and is crushing my ability to get them out of FHA and into a conventional loan because they bought a pool. And by the way, I refinanced them a year ago, got them a lower rate on FHA. At that time, they didn't have enough equity. And we didn't care about the fact that they had a pool loan because it wasn't a second mortgage. Fannie Mae is redefining how we look at these other liens, and they're treating them like they're second mortgages. So the UCC filing has to be removed or it's counted as part of the combined loan to value. Again, as a purchase, if the new homeowner is taking over the solar debts, I don't know if the UCC is removed and a new one is filed afterwards, in which case maybe we have a loophole that we don't care about. But on a refinance, some of these solar lenders will remove their UCC filing as a courtesy and then refile it after we refinance. If they do that, I'm cool, I don't care. But if they won't remove it, then they have to subordinate. And if they're subordinating, that's what's triggering this increase in the debt, or excuse me, increase in the loan to value, because we're treating that subordinated UCC filing as a second mortgage. We're going to talk about purchase power agreements. Purchase power agreements, again, I'm going to get into more detail when I show you guys Fannie Mae's guides, but purchase power agreements are really just a new energy company. You're basically saying, hey, the solar company is now my energy company. I agree to buy my I agree to buy my energy from said solar company at 19 cents a kilowatt, 15 cents a kilowatt. I don't know, but it's a purchase power agreement. They own the equipment. You are not paying anything for the equipment. You're not buying the equipment. You don't own the equipment. You're simply, the power generation machine is on your roof, and you are simply paying for the power that you use. And we never, ever, never, ever, ever make you count your electricity bill as part of your debt to income ratio. Yet Fannie Mae now says if you have a purchase power agreement, we have to count that payment against your debt to income ratio. So if your buyer is buying a home, and again, this is how I read it, and we've interpreted this a couple of times. I'm sure it'll be reinterpreted a couple of hundred more times because this is new information and this is how this all comes out. But I'll show you in a moment where it says it. In Fannie Mae's guide, it says, if you have a purchase power agreement, that payment needs to be included in the debt to income ratio. Again, for a borrower that, if they were assuming the solar loan, we've always had to include that in the monthly payment, and that has sometimes thrown some deals off because the debt to income ratio is pushed over the maximum. But in this case, not only does it impact, if it's a solar loan, it doesn't impact only the debt to income ratio, it also impacts their loan to value, because that now counts as a lien on the property. But on purchase power agreements, they're making us count the payments into the debt to income ratio, even though you're literally just buying your power from the solar company as you use it. They're still requiring us to count it as their monthly payment. It applies to pool as well as solar and any other financing that has a UCC filing. And we are unclear right now on how Fannie Mae and Freddie Mac are looking at this. They don't have a rule. Here's the problem. Everybody, and I mean everybody, both FHA, VA, Freddie Mac, and all mortgage lenders, treat Fannie Mae's guidelines as the gold standard. If Fannie Mae says something is a rule and another rule book does not address the issue, then we default to Fannie Mae's rule. Because everybody says, hey, Fannie Mae writes all the rules. We don't need to rewrite every rule. We're just going to default to what Fannie says unless we say something otherwise. And that's pretty much how all lenders look at things. When all else fails, if FHA doesn't address an issue, then let's treat it the way Fannie Mae treats it. If Freddie Mac doesn't address an issue, let's treat it the way Fannie Mae treats it. That's a major problem right now, because Summit Funding is trying to get answers we've literally got our attorneys involved, head of underwriting. We are trying to get answers from Freddie Mac and from FHA to have them put in writing what is their rule on this, because the lack of a rule means we have to apply, or we need to apply, whatever the rule is that Fannie Mae is using. All right, so Kathy, I just saw your question. Is a purchase power agreement considered with a lease and not a purchase? Is the purchase power agreement considered with a lease and not a purchase? So 3 different types of solar financing that I am aware of. So the first one is you own the solar, the panels, and you're just paying, you bought them, or you're paying a monthly payment to pay them off, just like you bought your car. The second option is you lease the panels, but again, no matter how much electricity the panel provides or doesn't provide, you pay the same dollar amount. So I'm going to use the example because I want to clarify this, where I think your question is going, Kathy, and then you can tell me if I'm wrong. I'm going to use this example like when you think about using a car, okay? So you can buy a car, and when you buy a car, you either pay cash to pay it off, or you have a monthly payment that pays it off in a certain amount of time. It does not matter whether you are in a lockdown in the middle of a pandemic or not, you could be never driving that car at all. You're still making your monthly payment on it because you own it. The same with solar that you own. You may own it and have paid it off. You may own it and be making payments on it. It doesn't matter how much electricity it's generating or how much benefit you get from it. You bought the panels, you own the panels. The second option is a lease. Just like you lease a car, you lease it for a certain period of time. At the end of the lease, you don't own it. But again, no matter how much you drive the car, except if you exceed a certain limit in mileage, but your lease is not cheaper just because you decided not to use the car. It's not more expensive if you use the car to the maximum of the allowed mileage. Same thing with leasing the solar panels. You're simply leasing the ownership, and whatever electricity is produced is what you get for the same fixed cost of the lease. The third option is what I'm talking about, and that's the purchase power agreement. You are not owning it. You are not leasing it. You're simply paying for how much power it produces. So you have no, you might have a commitment, you might have an agreement. It's kind of like renting a car by the mile, okay? It's kind of like going to U-Haul and saying, hey, I want to rent one of those $29 U-Haul trucks. Absolutely, it's $29, but it's also 40 cents a mile because you pay a whole lot more for the mileage than you do for the U-Haul truck. So a purchase power agreement, you're not buying the solar panels, you don't own the solar panels, you're not leasing the solar panels. You're simply paying for every kilowatt you use. If you never turn on your electricity, you won't have a payment on the purchase power agreement because you never used any electricity. Just like if you don't have solar and you use Lodi Electric or PG&E, you won't have a bill unless you turn on your light switch. But if you keep all your lights, you unplug your refrigerator, you unplug everything, you didn't use any electricity, you don't pay a bill. That's a purchase power agreement. Kathy, help me if I went down the wrong road there, but a purchase power agreement is not a lease nor a purchase, but we still have to count the payment now. And I'm going to dive into kind of how all this works. So the first thing I'll tell you is a UCC filing, and this is public record, so ignore the information that's on here specifically, but a UCC filing right down here. Let's go back here. All right, so right here at the bottom, it says this is a financing statement. That's the key that Fannie Mae says we have to look for. If the financing statement is a fixture to the property, so that's the key Fannie Mae's paying attention to is, hey, is this UCC filing a financing statement that's a fixture to the property? And in this case, this is a swimming pool financed by Aqua Finance. So that's what this was recorded for. And now I'll dive into Fannie Mae's guidelines so that we can spend a little bit of time having fun with what Fannie Mae tells us. All right, so here's the rules from Fannie Mae. This was all updated. So basically they're saying, look, we have a concern about solar and how we count it, and they look at the common ownership or financing options are borrower-owned panels, lease agreements, separately financed solar panels, where the panels serve as collateral for a debt that is completely separate from any existing mortgage, or a purchase power agreement. So they're breaking the solar rules into, or the solar options into these four categories. Penny, you said, Penny, you asked, a PPA is where you pay the amount of energy that is produced from the solar, not what you use. Oh, okay, so you pay for what's produced and not what's used. All right, well, you pay per kilowatt. That's all I know, is you pay per kilowatt. Okay, so Fannie Mae says, hey, no problem. We will do loans on properties that have solar panels if the borrower is going to be the owner of the solar panel that was paid in cash, included in the home purchase price, or otherwise repaid in full, or it's being paid off by the first mortgage, we're fine. We don't care. So if the panels are owned by the borrower, we don't care how you ended up paying for them, but if they're ultimately paid off, it's kind of like if you paid off your car by, refinancing another car. Well, but that car's paid off. So Fannie Mae says we're cool with that. Properties with solar panels financed under PACE loans, we cannot do. That's never changed. Fannie Mae is not okay with solar panels, and they will not be, Fannie Mae is not okay with PACE loans. They never have been. So if you have a property with a PACE loan, Fannie Mae will not allow us to finance a property that has a PACE loan in play. You guys should be familiar with that. We are required to determine ownership and financing of any debt We're going to find it typically on the credit report, but the truth is we're going to find it right here through the UCC search. And this is where it becomes very confusing. And we have to look up the UCC, and we have to determine if it is a fixture. So here's the if-then stuff. If the solar panels are financed, so they owe money on it, and the solar panels are the collateral for the debt, and they are a fixture to the real estate because a UCC filing has been recorded to say that. So remember, the key here is we have a UCC filing that says this is a fixture. So it shows right here as a fixture. So if you borrowed money for the solar panels and you owe the money and there is a UCC filing, we have to take a look at the credit report. That's fine. Include the debt in the DTI ratio. We've done that all along. If you have owned solar that you're making a monthly payment on, we've always had to count the payment on that. Here's the big kicker. Include the solar panels in the other debt secured by real estate in the combined loan to value ratio calculation, because a UCC fixture filing is of record in the land records. Okay, so that's their complicated way to say, look, if the UCC is recorded that says it's a fixture, that this is part of the property, the panels have been installed and are part of the property, I have to count that debt against them when it comes to their combined loan to value. And at the very least, that makes their interest rate more expensive. 100% of the time, it makes the interest rate on their primary mortgage more expensive, and it might make it a whole lot more expensive. All right. This goes on to say that if it is non-mortgage debt, in other words, but it does not appear on title. So if there's no UCC filing, I still have to count the debt to income ratio, but I don't have to count it in the combined loan to value. So that's where the key was that I said, if they will remove it, if the solar company or the pool company will remove the UCC filing, then I don't have to hit them with a higher interest rate. But if they're unwilling to remove the UCC filing, then we do. The question I don't know is, on a purchase transaction, is the UCC filing always removed? Because that UCC is in the name of the prior owner, and will they record one afterwards that we don't care about? That's the piece that I'm still trying to sort through. So the fixed, by the way, this will cause a problem though if somebody's refinancing a property to buy something else and you're trying to get the money out of that cash out refinance. This can cause a major problem, because this will also limit their amount of cash out, because this is considered part of the mortgage debt. So if they have a lot of lendable equity, but they owe money on one of these UCC filings, that takes away their amount of money they can pull as a cash out refinance. All right, here's the part where it talks about purchase power agreements. Lender requirements for properties with solar that are leased or covered by a power purchase agreement, a PPA. And Kathy, I'm gonna, let's see here. Kathy said, the solar company I'm dealing with now didn't do a UCC filing. How do I look up the UCC filing to confirm? So the title company would have it. It would be one of the exceptions on the prelim. It'll say UCC filed by a particular entity. So title can search that for you. So here's what Fannie Mae says about leased solar panels, which we've always had this issue with leased solar panels, but now they're including solar panels that are covered by a power purchase agreement. We have to review the paperwork, no big deal. The monthly lease payments must be included in the debt to income ratio unless the lease is structured to provide delivery of a specific amount of energy at a fixed payment and have a production guarantee that compensates the borrower on a prorated basis in the event the solar panel fails to meet the energy output required in the lease period. I don't know why that just popped up. Let's get rid of that. All right, cool. All right, so once again, why are you popping up? Let's get rid of that. All right, let's hope that doesn't happen again. Okay, so again, guys, I'm still trying to figure out the wording on all of this stuff. So I'm working with you to help me figure out how to interpret this. But here's the piece that is a bigger kicker to me that I mentioned earlier. Payments under a purchase power agreement where the payment is calculated based on the energy oh, well, there you go. So Penny, you said it's based on the energy produced. So if it's on a purchase power agreement where the payment is calculated solely based on the energy produced, that may be excluded from the debt to income ratio. So Penny, you seem to be my resident expert. Do all purchase power agreements base on the amount of energy produced? Because if that's the case, then I think we're fine on PPAs. Again, guys, there's so many nuances to this that I'm trying to figure out, but we're learning together. All right, value of the solar panels cannot be included in the value of the appraised property if it's a lease or a purchase power agreement. But what Fannie Mae does say above, and I won't find it, or probably won't, is right here. They do say if the solar panels, I'm talking about solar panels that are owned and they're treated as a fixture, we have to count it in the combined loan to value, but you also get to count the solar panels as part of the home value. Provided the solar panels cannot be repossessed for default on financing terms, we can instruct the appraiser to consider the solar panels in the value of the property. But if it is not on title, if the debt to the solar panels is not recorded on title, then we have to instruct the appraiser to not provide value of the solar panels towards the appraised value because the panels are collateral for another debt. Okay, in other words, the panels themselves are the collateral if it is financed and the debt is, and it's not recorded as part of the property, then we cannot include it as part of the value of the home. Again, a whole bunch of ifs and thens here. If it is leased or a purchase power agreement, and this part has not been a surprise, this has been pretty standard, the value of the solar panels must not be included, excuse me, where did I find that here? And the real, I knew that part. We were talking about something about the appraised value. The value of the solar panels must not be included in the debt secured by real estate because the document, yep, that part makes sense. I know for sure somewhere in here it also says the appraiser cannot count the value of solar because guys, it's a leased solar panel. Like you can't count, it's a lease. It's gonna go away in the end. You don't own it. The new buyer's not gonna own the solar panels. Same thing as a power purchase agreement. The value of the home is not increased. Your solar guy sold you on the fact that it will increase the value of your home, but the appraiser is not allowed to count the value of the solar panels in the value of the home unless it is recorded as a UCC filing as a fixture. So if the solar panels are marked as a fixture, that is the only time that we are being told that the panels can be included in the value of the home. All right, I left 3 minutes instead of 92 seconds that I promised. If you guys have any other questions about this, please feel free to post them into chats. A lot of changes. The biggest change is the fact that we have to, if the UCC filing is there and it's marked as a fixture and it's not removed at the time we record our first mortgage, then it has to be subordinated and it counts as a second mortgage, even though it's not a deed of trust. Never before in my career have I had to count something as a second mortgage unless it was a deed of trust. And in this case, or at least I can't think of any time that's happened, but in this case, we are being required to. And so there's just another layer of complication that comes along with our clients having solar on their home. The biggest encouragement I'll give you, and by the way, I'm filling a little bit of space right now, so in case anybody has questions, now would be the time to be typing them in. But the biggest thing that I implore you, as you call your past clients and you talk to them about how their house is doing, you have the love it or list it conversation with them. Hey, do you love your house? Great. Call my guy, John King. He can help you get a better interest rate and a lower payment. If you don't love it, list it. Now's the time to sell your home. Love it or list it. Best conversation you can have. Best reason to call all of your past clients. When you have that conversation, bring up the topic of solar. Do you have solar? If so, how did you do it? What implications are they going to have to that solar when they go to sell the house? What I mean, they're already in a contract. They might not have any options right now, but at least they'll be aware. At least they'll have some time to put that into their evaluation of what they're going to do when it is time for them to sell their property. All right, my master plan worked. I got one more person to ask a question while I was dragging on here for the last 90 seconds. Chris said, I purchased my solar 10 years ago for cash. How do I find out if it's part of the property? Call your favorite escrow officer and ask him if there's a UCC filing on the property and see if it is attached as a fixture. Okay, again, guys, I am not claiming to be an expert on these rules. There are too many ifs and thens that I'm rolling this out right now. Chris, the thing that I wonder, if you paid cash for it and it's owned, then I don't think it falls under this criteria, because technically this says if they're financed and collateralized, that's when we have to make sure it's a fixture. If they're financed but not listed as a fixture, I can't count it as part of the value. What they don't give as a choice is, what if the solar panels are paid in cash and they're completely paid off? Can I still count it in the value? I don't see in here where that answer is. But I think that's part of what you're saying is Fannie Mae still allowing me to count that as value, even if it's not a UCC filing? And again, this part here does not really tell me anything more about it. So guys, we're still digging through this and helping to understand it. I wanted to give you advanced information. This caught me by surprise on 2 of my transactions, that it ended up they have this UCC filing and it's causing a problem with their ability to pull cash out of their property. And again, I haven't been hit yet on any purchases, but there's some pieces in here that I think you need to be aware of, because if it does come up, at least you know where it's coming from. So I appreciate you guys' time. I apologize for being a minute late. Hope you have an absolutely amazing week. And don't forget, I actually do mortgages for a living as well. So if you know somebody who needs to purchase a home, I would love the opportunity to take great care of you and your buyer. Otherwise, have an absolutely amazing week, and we'll see you all next Monday, 3 o'clock. Bye-bye.